Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, February 4th, 2026. All right, I just fired off a post. In that post that I got out to you was just a day trading op. That is not what this site's about. Once in a blue moon, when I'm bored or the opportunity's there, markets are quiet, I'll just get I'll share those for those interested. And let me say this: if that's not your wheelhouse, if you're not familiar with what that is, by definition, a day trade is a trade you enter and close out on the same day. With Alphabet earnings, it's a counter trend trade. You know me. I've been clearly sharing my longer term, intermediate term views. We've had additional sell signals trigger recently, but it's just a bounce trade. That's all it is. And again, if you don't day trade, probably not a good time to start. Watch, learn, cut your teeth on it. But that's a 1% bounce, and I don't have to tell you if you trade the NQs, the Nasdaq 100 futures, which are leveraged, or the MNQs, the mini version. I don't have to tell you how much money that'll put in your pocket. Just a quick 1%. And it's also a term, I made up years ago called velocity. If you can get 1%, do it once a week. 52 weeks in a year, you're doing pretty good. But anyways, let's just move on, look at the charts, see what's out there. Remember, bigger picture is this trading range in QQQ right here. Oh, well, let me go back to the 60. There it is. I've had these levels on the chart for a while. That's that previous reaction lows we cut. Actually, if I zero in on the line, there's if I missed that low is right under there. About you can see this is how traders trade. You turn off all the lines and draw it across. That's the reaction low. You can see that's exactly where they stepped in. Now, it's a level I think is going to go, and it can go today. So, like I said, win or lose, I'm out before the close today. I'm not going to take longs home into Alphabet earnings because you guys know which way I think it's going to go. I've already covered that. So it's either we get a bounce or not. No big deal. And longer term accounts, no reason to try to game a 1% bounce. That's only if you have an active trading account and if that's in your wheelhouse and skill set. All right, back to the bigger picture. The bigger picture is we remain in these multi-month trading ranges as boxed in. I know most of you probably getting tired of hearing about it, but that's it. You can't force the market. It's just as they say, you can't squeeze blood from a stone or water from a rock. You can't force the market, but what you can do is recognize that. And like I said, what I see when I see these kind of trading ranges, it's often like energy building like a coiled spring, and then once you break out, the moves can be pretty swift and big and very profitable if you're on the right side of it, and very unprofitable if you're on the wrong side of it. So recognize it. We break down and break below it and hit the 200s and pop, or it's a false breakout, or whatever happens, just have a trading plan. Stick with your trading plan. That's about the best advice I can give. I can't give individual investment advice, but generically I can tell you, have a trading plan, what you're going to trade, why you're going to trade it, when are you going to enter, and where you're going to take profits if correct. Those are your price targets. And where you're going to exit if wrong. That's your stop loss. And then the easiest thing in the world, I think it's the best invention in trading since sliced bread, are OCO orders. One cancels the other. I'm trying to draw it out here. Just imagine that's a C and that's an O, and some brokers call them OCAs. And that's simply you have one order at your profit target, good to cancel, and another at your stop loss. And what it gives most traders, and I can tell you this is where I've seen in the past where I've struggled, most traders fail, even if they have the skill sets, the ability to have a natural feel of the markets and reading charts or a decent trading strategy, is discipline. And they second guess a trade that moves against them, and they pull the plug too long, close it out, either for a loss or a small profit. And if you're doing that, and even if you're using trading plans with a favorable risk reward ratio, like a 2, 3, 4 to 1 risk reward ratio, 3 to 1's a sweet spot, but it depends on every trade. Risking $1 to make 3. Well, you don't have to be, you even can bat less than 500 or right about 500, 50-50 on your trades. And if you're only risking $1 to make 3, you're going to make money over time. But if you cut your profits short every time there's a big things start to go your way, and you're taking early profits, but you're still letting your stops hit or exceed, you're going to lose. That's it. Okie doke. Let's move on. That's it. The trading ranges are there. We've now entered. What's worth noting. I always when I recognize trading ranges, I've shared this with you many times over the years. Something just a long time ago, I would notice that pretty much in the midpoint of the range, and it doesn't always have to be exactly in the middle. Sometimes that line's a little to the upper end of the range or a little to the lower end, but that is a sub-level there where when you're above it, it's support. And when you break it, like we did today, usually the next stop is the bottom of the range. So again, that day trade op is a very contrarian counter trend, but I'll show you why, some of the other logic behind it today, whether it pans out or not. And then let's not forget, because I never do, the weekly charts. This is where what formulates my longer term, intermediate to longer term outlook. So not over the next couple hours. That's what I just shot out today with a little bounce trading op for 1% in out, wham bam. This is where indicates to me where the market's going in the coming weeks to months. And just to recap, the Nasdaq 100 put in a bearish engulfing candle back here the week of, as highlighted at the time, November 7th. And so far that means that the body of that candle engulfed the previous candle, the body of the previous candle, actually I believe the previous two right there. And these are what we call potential reversal sticks. You want to look for them at the end of after a prolonged uptrend. You don't want to just look for them coming off the lows. They mean nothing if you get it right after a correction or a bottom is in. And then that's it. So your stop will be somewhat above the top of the high of that day, of that candle, the skinny part, the very high. And so far, that's what's happened. We made what I call an ADL, almost divergent high. This is really an ADH, a second, because we were slightly lower. The high for that day, Wednesday the 28th, was 636.60. You can see in the pop-up box to the left, versus that one there. That was the week of the bearish engulfing, and that was 637.01. And again, I didn't get nitty-gritty. If you went up just a fraction of a percent higher, it's the same difference, right? Basically, the nature of divergences or momentum indicators tell you made roughly equal highs with lower highs on the indicator, some momentum indicators, just exactly like you did back here, right? And then boom, that's what happened. So that's kind of bigger picture. And then my biggest picture I go to is monthly charts, and this kind of helps me formulate where we're going, not in the coming days or weeks, but months and even years. And that's the long-term chart. Okay, what I just toggled on is one of many, but one of my favorite indicators that I use, and that's the PPO histogram. Now I had the PPO here. The histogram is simply a visual representation. The histogram bars, you have a zero line, and this is your PPO, and you have what we call the PPO line in blue, and then the signal line in white. And when those lines cross, those are bullish or bearish crossovers. And the histogram just represents when it crosses the zero line, meaning it goes from red to green, that's when you've made a bullish cross. And when it goes from green to red, you made a bearish cross. And so there's a lot of uses that I find. I look at divergences. I look at zero line crosses on the PPO itself to denote major trends. That's a big trend change. So for the most part, this is the financial crisis. And this indicator has told you we've been in a secular bull market. Even though we've had some big drops, 38% or 6, whatever it was, 31, 24, 26, 25 last year. Those were just corrections in a much larger bull market. So we're far away from that even crossover. But when it does, just understand that we'll be most likely in the early most likely by the time it crosses, based on where we're at now, we'll probably be pretty knee deep into the bear market, the next big cyclical true bear market that lasts more than just a few months, right? Anywho, so we're comfortably above that. But here, let me just move forward to what I was wanting to show you here. And again, things I've covered in the past. So these are the negative histogram bars, right? 1, 2, 3, 4, 5, 6, 7 right there after the cream, 8, 9, and look where we're at today. We're at 0.00. Now it is a monthly chart, So this is very key to what I'm saying here. All that matters is how you close the month. So what do we? I don't think it's a leap year, is it? So it would be February 28th. It is, whatever that last day. Well, whatever the last trading day of February is, whether it falls on a weekend or, what day of the week that falls on. I don't know if the last day of the month falls on a weekend, is what I'm saying. And so then we'll look at that. And you can see these are the drops from the previous highs associated with that. 18%, 55, 16, 13, 26, 24, 31. And that was COVID. If you blinked, you missed it. And it was 36 from high to low in the S&P 500, by the way. 38. And I'm just, again, measuring from the highs to low. 25. So with zero exceptions going back for decades here, not a single whipsaw. And that was brief, but it happened. It was real, and it would have been a lot worse. I call my nickname for COVID was Ursa Interruptus, a bear market that was interrupted by massive stimulus. That's it, guys. I just want to say, and this just helps to kind of formulate, where we're going longer term. So I have, both short-term trades out there and then longer-term trades, longer-term targets on the Nasdaq 100 and the other indexes. And the other takeaway from this, you look at these histogram, you don't have to be a seasoned expert, market technician, chart reader. These are momentum indicators. And here it did fall off pretty quick. I'm going to say that in the financial crisis. But every other time we made a crossover, again, it doesn't take a rocket scientist to analyze this chart and see the trend where you were going. Again, these are momentum indicators. That just shows in a bull market when momentum starts to slow, eventually it takes a while, especially in the stock market. It's like a big super tanker turning in the ocean. It doesn't turn like a speedboat on a dime. It takes long, slow arcing turns. But again, it's pretty clear. And there are no guarantees. Sometimes, let me find one. You don't even have an example here. On other securities, I've seen the PPO looks like it's about to cross, but it doesn't. All right, so that's it. So again, hopefully that you can understand that's where we're at. You don't even see the bar this month. See, we're flat on the line right now. Earlier today, it was like 0.01, right? We just bounced off the lows right when I got that trade out here, looking for a quick bounce in the Qs. What else? So that's very long-term stuff. All right, let me show you what else here. The MAG 8. Okay, so yesterday I shared, and I made point to do a video to kind of put my thoughts, express my thoughts, software stocks. The comments have been quiet, and I know that. When we started, I was shorting. We have quite a few trade ideas. If you notice the ones, even another one hit today, we've been closing out short trade ideas. We're on the software sector. So, and if you look back on a lot of those, the ones that I shorted was a few months back in December, whatever, when the stock market was blasting through and the cheerleader squad was coming out on CNBC and Bloomberg, new highs in the market, S&P 500, Dow new highs, even though the Nasdaq didn't make new highs. And so that was when I was picking on the software sector. And you can, again, look at the trade ideas. A lot of those are there. And so yesterday, I threw it out as a long, both as either a pure play long or a indirect hedge, where you can go long software if you're short the broad market, because I expect software now to outperform. Now, outperform doesn't guarantee it goes up. It just typically means it falls less. And we also had a pretty precise exit and a stop loss. I'm not going to get married to the software stocks. I fully embrace and believe the narrative that AI, to some degree or another, a lesser or higher degree, is definitely impacting or will impact a lot of the software companies. Not all of them, but a lot of them. Adobe is one that comes to mind. They've forever and a day, Adobe Illustrator, from what I know, I'm not a graphic designer, but it's been like the gold standard for designers. And I told you guys I was very impressed. I had that Google premium subscription or whatever. They give you the full nano banana thing with the Gemini, the latest Gemini 3 launch. And I've just been blown away at what it can do with not just videos and pictures. Well, that too. But I already made some examples. It came up with some great ideas. My wife and I are looking at a project on patio of our house, and an idea that we didn't even have in our head. And when I was kind of taking a picture and telling it to add some things here, it added additional things. Anywho, my point being is that like you would spend countless hours going back and forth with an architect or some type of designer for that. So yeah, I do see where those companies, some of them again more than others, are going to be. But what happens is a lot of that's been priced in, I think. And I'm going to go. Oh, sorry, I went off on a tangent. So if you look today, this is the Nasdaq 100. Here are your what I call the Mag 8s, right? The top components here. Go down to Tesla. And what's up today? Well, the one that I, yesterday felt, well, we had two shorts and two trade ideas recently out of these guys. We had Apple and then Microsoft. So let's talk about Microsoft because that's the king of software stocks, right? And Mr. Softy. I mean, maybe they call it, well, the soft, I'm sure it's a playoff software. All right, so that's it. And it hit trendline support. So I've been bearish on this stock since the divergent high, giving you sell signals there. Sell signals, 200's broken out, check marks. These are green. I put them as question. They were supposed to be check marks. Then we, gamed it for a quick bounce there. It was a long setup. And now, again, this isn't mere coincidence that it hit a massive, major trendline support. Now, guys, I expect it to ultimately take that trend line out. I'm just going to tell you this is one of the Mag 8 stocks, and it's beat down the most, and it's at long-term support. So, it's that level may go, but as of today, in a sea of red, it's up, and it is the biggest software stock out there, right? It's the king of software, and that was at XSW, the software ETF, holding like a world champ. Pierce down below there on a little opening bounce this morning. It's funny because when I gave this trade to you yesterday, then I open my news feed at night. It's pounded with all the media, these Johnny come lately, technicians, and one of the articles, I don't have in front of me a circle why this is going to keep going down, and it might. Look, I'm not getting married to this one. There's your suggested stop, based on the bounce target there, but they're now talking about how software stocks are, getting killed because of AI and all that. But this is where we were short, and this is where everyone was bullish on them, the media. So you almost have to take that. Again, I always say I'm not contrarian for the sake of being contrarian. First and foremost, about everything is charts. The charts, all the trade ideas that we entered, including. There's that comment on that last post. I got it too. I fired it off quick and then realized it was Typo City in there. But a lot of these Shopify, that's software. We were shorting that back there, and quite a few lately. So what I'm getting at there, a lot of them are coming in and hitting in Toast. TOST also hit today at fourth target. We shorted right there. Back before most of the world knew there was a bear market coming in the software stocks. So. And again, it may go through there, and ultimately, I think it will. If we're going to get the bear market, I think in Nasdaq 100 is going to fall over 50% in the next year or several years coming up. Then yeah, these stocks are going a lot lower, and they could break here. Like I showed you the margin bubble. When the margin bubble pops, silver was a shot across the bow, I believe, even though it's a very relatively small percentage of people holding silver compared to like. S&P 500 and big tech stocks and all that, but I think it kind of shows the vulnerability, especially for people that have become dismissive of hearing the cries from me and others about the overvaluations in the market. Again, I'll never overvalue. I'll recognize, I'll talk about it, but that's never a sell signal for me. Overbought, overvaluation, parabolic uptrends aren't a sell signal. The break of them are. And so, but what I showed you is that margin bubble yesterday. It goes back to that video. If once it starts to unwind, you can't put that genie back in the bottle. It's never, like I said, it once it turns, that's usually it. And then it's a powerful kind of steamroller that will take out even the most, best support levels. Overbought then oversold becomes more oversold. Here, let's go look at TOST. Let's pick on that one. I haven't even looked at it since I threw it out to you. So that's it. Brief overshoot, holding right on the line, just like Microsoft. So basically what I'm seeing is Microsoft, one of the Mag 8 and others. I'm going to go over the rest of them real quick, and then I can get the video out to you guys. So many either at or very close to support. And again, I what I do on this side, I try to share years of experience, things I've learned that Alphabet, although I believe it'll be the last of holdouts, and I believe it will be down quite a bit in the coming weeks to months and take the market down with it. That's what I believe based on my read on the charts and everything. However, it may not. Number one, I may be wrong. And number two is when there's a big move in the market right before a big earnings, remember, it's Alphabet tonight and then Amazon tomorrow. Usually you get a little bit of a mean reversion. Usually the shorts that are shorting today, the active traders like me, came in the day short, will do what I just did, cover and say, you know what, we're down. The S&P or the Nasdaq's down. What was it, or what is it? Down over 2%, about 2.5%, close to when I get that out to you. That's usually about all you're going to get right in front of earnings, because then the shorts are going to cover just in case Microsoft blows the cover off the ball. Now, they probably will be the best quarter ever blowout, or who knows. And look, here they're kind of quirky because they're also one of the kings in the AI race. Yeah, the software company. But again, they're in that ETF. So, and what I showed you, it's not one, it's many, not all of them, but a lot of the big software stocks are all hitting very good support that I think will be at least a speed bump in the road, even if they're going down a lot more in the coming months to even years. And that's it. Or not. And if those supports, look, remember, I always say support is support until unless broken. If Microsoft clearly takes that out and we start to get a big red, especially a daily and even better a solid weekly close below it, remember, it's a long-term uptrend line on Microsoft. This is my path for Microsoft that, I still have it going in the coming years. But let me see if I have a clean board here. There it is. This is a trend line that's a long-term, very powerful uptrend line. And so anyway, that's like I often say, man and machine alike are likely to see and buy the initial drop to that trend line. And so far they did. You can't argue that. It's a reaction. It's what I call my hacky sack reaction. You drop a hacky sack and a ping pong ball on a concrete floor. Ping pong ball will bounce. That's one reaction. A hacky sack will just stop. It goes down and then thud. And that's the hacky sack reaction so far. So that support is held. We haven't had a big bounce or any really meaningful, little bit so far, but immeasurable. But we're right there on the line. All right, and the rest of them. NVIDIA, again, my thoughts. NVIDIA lights out under 165.44. 200 days are coming up. So you're coming up near support. You're also at this uptrend line, which is the same as that head and shoulders neckline I gave you a couple of months or weeks back on the, where do I have it? I think on the weekly. Do I have a board for you here? Yeah, there it is. This is the neckline that I gave you back on whenever that was. What's that date? Created that back on December 11th. And I said, head and shoulders, they're one of the most easily recognizable patterns. So I think they've thrown out a lot. Traders use them. I've seen over the years traders use them in the wrong form too. They're topping patterns. Inherently, a head and shoulders is a topping. You have another one called an inverse head and shoulders. It looks like this, that you look for at the bottom of a market. Now you can have an upward, level, or downward sloping neckline. It doesn't matter. What you want is approximate symmetry. And then the thing that where most traders I've seen over the years, jump on these and they don't work out, is you need to scrub it for volume. The criteria, stockcharts.com has an excellent description in their chart school. If you want to check that out, it's free, even if you don't have the subscription with them. But you want to see the move off off the head and the right shoulder. It doesn't matter about the left shoulder. The head and the right shoulder, you want to see the formation of the head back down to the neckline. Fairly impulsive and on increasing volume. You can see some uptick in volume there, followed by a lower volume move back up. See the volume drop off. And then when I gave this to you, I said we need to see the right shoulder form, ideally on above volume. The volume's not great so far, I'm going to say that, but it just helps. It just helps to confirm. But I can tell you that the neckline is pretty well defined. And we're coming up on that, which is also these 40-week / 200-day moving averages. So it's a confluence of support. It's a level I expect to go when it goes. NVIDIA is going a lot lower. I've given you long-term targets that are really, it's the same long-term outlook and analysis on this trade that I gave you back here in 2024. And what happened? We hit my first target. T1 was right there. I gave you all these other targets at the time, 4 total. We hit my first target, bounce as expected. Told you back then, covering it and all shorts going long. Made a marginal new and still divergent high. And so once we start the party, we've already hit T1, so it increases the odds we may go down through there with little to no reaction, and that would be a drop to T2, which is going to be, again, just assuming I'm right. For kicks and giggles, just assume that. My next target's 64%. Try to imagine what the largest publicly traded stock, the largest component of the Nasdaq 100 and S&P 500, what that will do, and more importantly, the poster child of AI, the undisputed heavyweight. So I know it's heresy from even, again, I haven't waffled on these, and I'm not married to it. If this NVIDIA wants to go back up, keep going up and go to the moon, then guess what? Next sell signal is never going to come. Right now, I don't have a position in NVIDIA, but I do, short on the market, and NVIDIA will need to go down, will greatly help if it cooperates with that trade. I'm talking swing trend trades. All right, so that's it. I just want to point out to you that it is at that neckline support plus the 200s right below. This is what I'm doing here, is just making a case. Alphabet, nice rejection. I told you after there was a breakdown, we back tested for the last several weeks. An impulsive rejection, but it gets taken with a big grain of salt because they report tonight. So ultimately, whether they pop after hours or tomorrow doesn't matter to me. My call is in the coming weeks to months. All the better. Look, if they get clocked after hours and tomorrow, that's it. The market probably just, it still has Amazon, but I'm going to get to Amazon one second. So these are still my price targets, and I've covered Alphabet ad nauseum lately. It's going to, minimum, my preferred current target, swing target. We're talking weeks to months out, is right here. Pull back to the 200 days in this 250, what is that, 257-ish support right there. Giving us, if hit, that's a drop of about 26% in Alphabet. So we'll see what happens. Apple, sheared the meat off this one, got in a hair early, took a little while, avoided our stop by the skin of our teeth, and that's it. We hit my first, second, third target, covered it there at the third target. T3 was right here on that line. The 200-day moving average, pretty explosive. Like I told you at the time, that's one you don't want to hold on. That's why that was a final target. Both man and machine alike will buy the first pullback in a long time to the 200s on Apple. Just like when you get too far away, you're going to get called back to it. All right. It's kind of like your dog on a leash, especially if you have one of those leashes with the little button with the retractable, rewindable, spring-loaded thing. You ever see those? And that's it. So Apple got too far away. And had to come in and check. Reflexive bounce, and I thought about putting it on as a short trade for you guys today, but again, putting anything on right in front of Amazon and Alphabet, it's not worth it. Let's just wait and we'll see what happens there. But it's at some resistance and overbought on the short-term charts. Oh, by the way, I told you a minute ago I like the PPO. And we were on a weekly chart when I was showing you that QQQ, but here's Apple. And what I do with every single stock, I don't just take the zero line for faith. I analyze each stock on their own. Apple, I have it slightly below. I have a yellow line at negative 0.02. So basically at the zero line. And I like to see the 9 EMA, which is the signal line, cross, because that's the slower of the two moving slower of the two. It's the moving average of the PPO line. And you tend to get fewer whipsaws. So what I've noticed on many stocks, including Apple, it delineates bull and bear trends. I'm just going to box it in. So when you're below, you were in a bear trend. Stock was falling. It tells you to be short. And when you cross over, that's bullish. Of course, I take it with other indicators as well. This whole trend right here, it captured. Then it flipped to bearish right here. Said be short. The stock dropped, and that's double digits. Trust me. Then it said long again for the bounce. Short, you can see it's just I love technical analysis. It just blows away fundamental analysis. Good luck trying to figure out these trends. This is swing trading. Investing, if you got a 20-year time horizon, buy Apple today, put it away. You'll probably be, glad you did 20 years from now. But if you're going to, you want to catch these rips and dips and make 10, 20, 30%, 10 on the corrections, 10 back up, 20, whatever it is, technical analysis is going to be a much better guide. And so where I'm going, okay, blah, 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 let's fast forward for today. So not only does a line help delineate trends, once you cross, it signals a new bear trend, but what it also does, it acts as support. Once you cross above, like you did right here, that's the 0 line, or in this case, the negative 0.02 line, tends to act as support on pullbacks and tells you can buy that level, stay long and strong until you cross. And then when you're below, it often acts as resistance when tested from below. Now, the signal line has a little room to go before it hits there. The PPO line's there. Sometimes that's it. Sometimes that'll stop it. But I just wanted to point that out, that this one, that's why I think Apple is a short trade here. It also aligns with my view on the markets. I just don't have a hard sell signal. It's not super duper resistance. And again, take it if you want. But if you're short the Nasdaq 100 NQ, you don't need to be short Apple. And it's just overlap. Sometimes it's just easier to short the index when you can make a case that the leaders are going to go down, the majority of them. Next up is Microsoft. I already covered that earlier. Okay, I covered that. And again, this is one that clearly, this trend indicator, you can see my purple line right here. You can see the level is. I'll turn it on. Where'd you go? I must have an extension. Yep, I do. I've started it way back here years ago, so I have to turn on that level. Nope, that's not going to do it. Oh, because it's a line draw, not a flat horizontal line. I have to do this with one of these, and it pops up the level. So that's at 0.063, and again, you can see that's the line I put here way back then in 2022. So that on Microsoft, that's the level that delineates the trends. And again, I haven't touched it since then in years. And you can see right there in a bull trend, it took that line back there, and we were in a bull rally, pulled back, that correction. You could have bought it there, but then it lost it here. That was that rut row moment. And look, that also coincided with a break of that uptrend line I had there, following the back test, breakdown and back test of the primary trend line and the divergent high. So that triggered and started a new bear trend, which is in. And right here, you can see it did a back test. It came back up. The white line, signal line, the last of the two to cross. That's not a whipsaw because that's the blue line that got above. The white line got rejected right there. And that also coincided with the rejection on the 200-day moving averages. Then we went down. That's when I pointed it out as a long setup with a break above that trend line. Hit quick second target hit right in front of earnings. Exit stock because of earnings and the 200-day moving averages. And it's keeping this bear trend intact. So that's why, again, at most maybe a reflexive bounce, and if not, then like I said, to me it's more of a hedge, potential hedge against a short on the Nasdaq 100 because some of the market leading stocks, not all, a few haven't given me the check marks I'm waiting for, and that includes Amazon. They're going to report tomorrow night. Remember, these are red check marks, meaning they're pending. And it's this uptrend line right here is the first one. That would be the first sell signal. We're below it now, but the day's not over. See, sometimes this is called a stick save. We got below it there and only to close back above. That's what I'm thinking. A 1% rally is going to park this one back on or close enough to the trend line to not give you that check mark yet. And even if it did, guys, they report tomorrow. So you'd have to take that breakdown with a big grain of salt. Now, if after the close tomorrow when they report, so then we're talking that's Thursday and then Friday's trading, if the stock is down here, I get a check mark on a break of that trend line. The next check mark comes when it closes below the 200-day moving averages or clearly takes them out intraday. And then the final check mark or the death blow to Amazon comes when it takes out 211, which is this purple line price support there. Because we'll be far enough from the 200s plus its nice price support. And when you just look at it from a bigger, longer term perspective, it's, you have this big divergence right there. So that's it. So what do we have? Meta. Here's a great example. Meta had check marks along the way, divergent high, breakdown, check mark. Again, I have them. I just colored them green. They should be check marks, not question marks. 200s taken out, 200s tested, rejected, all check marks. But then they reported and they took it out, and I acknowledged it. I said that is on face value nothing but bullish unless it fails. They haven't failed yet, but look at that fade so far. Now, if you're bullish, and this is again why I think we could get one little bounce before the next two bigger FANGs report tonight and tomorrow. This is a back test of the 200-day simple moving average. You can see how well, and I've gone over it, how well those MAs have acted as support and resistance. And so if it goes much lower, it's going to be this whole thing will be a massive bull trap. All those folks and computer programs that bought Meta because it popped back above the 200s will realize the sole reason they bought it is now negated, and therefore they should stop out and accept their loss on that trade, especially those that chase that pop. But until then, support is support until it's broken. So those are the check marks. So even though we've had check marks along the way, we had one undone recently. That's what I should have made that red either way. And it'll go green again if we drop below there. Then you look for breaks of these previous lows, and that should be lights out for Meta if those two are taken out. Broadcom breakdown today. When did they report? Oh no, they're not reporting for about a month. So that one's a check mark now. This is green. The day is not over yet, but right now, unless it can rally into the close and stick save in one fell swoop. See, I have that big primary purple uptrend line with one violation I allowed. Sometimes if it's brief, it's okay. The trend line's still intact, and it's with the 200-day moving averages. Again, I've been covering these stocks very, very precisely, these Mag 8 stocks lately, and that's right now, unless it's undone by the close today or in the next few days, that's a sell signal on one of the Mag 8s that I was waiting for, and so that should be. I'll wait to see how we close today, but so I'll give that turns into a green check mark once you've taken out the 200s. And again, you can go back as long as you want and see how well this stock does. Once it takes the 200s out, it lost them here. That might not look like much. From the 200s, it dropped down 25%. So it hit this longer term. That's a 200-week EMA that it hit there. But that was a 25% drop. Took them out right here, and it dropped 50%. Took them out right here, and it dropped 26%. And so, I mean, if you just simply were long this stock above its 200s, short below it, you would blown away the tremendous performance the stock has made over the years. That's it. And you tend, whatever I was going to say. Yeah. All these buy and sell signals need to be taken in conjunction, in my opinion, with other buy and sell signals. You can use just the strategy of being long or short over the 200s. In a secular bull market, it's going to do, you're going to be above there most of the time. But when the primary trend changes, then what we're going to be doing is shorting rallies back into the 200s. When the primary trend changes, well, one of the first things, see the majority of the Mag 8 stocks, the indexes, of course, under their 200s. And then I have longer term indicators we'll zoom out to on the weekly and even monthly charts to see if those longer term trend indicators flip as well. Tesla, check mark on that trend line break there, divergent high, check mark, then the check mark here, breakdown, back test, followed by rejection. That was a check mark coming up on the 200s, and that will be your next sell signal in Tesla when both the 200 simple and exponential are taken out. As of now, it's still above the 200s. So that's it. I'm going to end the video here so you can see that we're getting close to, market action's been soft lately. So the shorts are working out, but it's just not that all-in moment yet, especially with Alphabet and Amazon reporting tonight. And, a lot of long-term, especially on the broad market, long-term indicators still bullish. So that's, and that's also kind of goes back to what I started the video with, just looking for a quick bounce in the close. Because of those reasons, they're likely, a lot of these stocks are right now at or very close. If they're below, they're slightly below key resistance levels. So you're probably going to see the machines come in, the algos come in and buy up this dip before the close today. And again, natural, regular investors that might be short today, active traders that just don't want the risk to going home short in front of Alphabet reporting earnings tonight. All right, so that's it. And let's start the video. I'll end the video with where I started it. That's the previous reaction low right there. We could carry higher than that. There's two options, by the way, if you want. If you want to take it home or take it a little bit into the after hours, you can just trail a stop up. At this point, keep your stops tight. No reason. You can even set a break even. We've already reversed off that pivot low. So you could move stops to break even if you took it at the lows. And then you lose nothing now because you're up a little bit and you make 1%. And again, day trades, by definition, you go with a much higher position than you normally do on a swing trade because you don't have overnight risk. And you're going to close this out, at least if it's an oversized position, before Alphabet reports tonight. And so therefore, right now, the risk is, for lack of a better word, minimal. It would take some crazy, nukes flying or some crazy, Trump's tweets are kind of losing their impact anyways now, with the whole taco thing, it's not, things aren't taken on face value much anymore. So there's not a lot between now and the close today that's probably going to stop this or take us down a lot further, in my opinion. All right, I'll wrap it up here, get the video out to you guys, and that's it. Continue to hunt for new trade ideas. I'll wait to see what Alphabet does. As I always say, don't read too much into the initial knee-jerk reaction. 3 components to an earnings report. Component number 1, the immediate release of the earnings report. Humans try to read through there. Machines are going to parse through the report, the initial earnings release faster, and algos are going to fire off. So you're going to get post-earnings volatility. I'm talking about Alphabet tonight and the market as well. And then component number 2 is the conference call. We've seen plenty of stocks blow it away, only to have a big reversal come when the conference call. Because the company gives negative guidance, even though they blew away the quarter, or vice versa. It can go either way, or it can build on a move. And then the third and last component is how the stock trades the following day in the regular session when all the players are on the field. Institutional traders, they're dealing with multi-million and billion-dollar portfolios. They need that liquidity to navigate and a lot of time to really digest all the information. So that's the third component. How does the stock trade tomorrow and into the end of the week? Okay, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.